welcome to another episode of Flux Insights. I'm Lisa Aziz, your host for today's exciting show. And joining me for this episode are key members of Flux's research team, Research Associate Mita Chaturvedi and Quantitative Research Associate Harinder Sandhu. Hello, guys. Nice to see you. Actually, at this point, let's start off with finding out exactly what it is you do here at Flux.
Hi, thank you for that introduction. My name is Mita Chaturvedi. I am a member of Flux's research team. I'm research associate here. So my team and I, we specialize in the crude oil and refined product swaps. We look at Flux's proprietary positioning data, add to that fundamentals based on just the global macroeconomy, or what's happening in the oil market. And we come up with actionable insights on emerging trends for our viewers or our readers. So we do this in the form of reports. So we've got daily, weekly, monthly reports, and we've got our lovely show over here. So so these insights are in the form of positioning insights in our reports or trade ideas, which we will see in this show as well.
All to come, Harinder.
And I'm a quantitative research associate, as you mentioned, Lisa. So my focus is on unpacking Onyx proprietary data sets. That's the commitment of traders data set that we obtain from our trading activity, really looking at that from a quantitative perspective. I work in with the team on the reports, more from the data angle to providing the insights from a data perspective in my day-to-day.
So much experience. Let's get on with it. And let me start too by telling you what Flux Insights actually is, though, and what you're going to learn in today's programme. So each week, our research team will dissect the latest trends shaping the oil market, which, as we all know, influences everything from geopolitical events, conflicts, inflation, right along to how much our energy bills could increase by or not this wintertime, and how much we might just end up paying at the petrol station to fill up our cars ahead of that weekend trip out. So with Flux's proprietary financial positioning data, we deliver a view of the oil market that you just won't find anywhere else. We're at the forefront of early trend shifts and can convert them into practical, actionable opportunities. So in the next half an hour or so, we'll be covering recent happenings in the market, followed by a positioning review, a deep dive into an interesting swap contract, technical analysis of the oil market, and, wait for it, a trade idea for the week. So with all that in mind, then, let's get stuck in. Mita, firstly, then, what's been the big mover in crude oil futures this week?
Thank you for that question. So Brent futures, this is just the M1 Brent futures, have been fairly range bound this week. Not a lot of volatility there. But the big thing that has happened in crude futures has been at the end of last week. We saw a Ukrainian drone attack on the Black Sea port of Novorossiysk. Because of this attack, M1 Brent futures climbed from a low of $62.25 per barrel on 13 November to above $64 the next day, and then it hit $65 just on the 18th of November, where it finally met resistance. So it's currently around the 63 handle. Over the weekend, we also saw an attack on Rosneft's Ryazan refinery. No oil product loadings are now planned at Ryazan until the beginning of December. In Novorossiysk specifically, so it's an oil terminal and it's one of Russia's biggest for a lot of oil products. They temporarily suspended oil loadings until Sunday. So it was like a 2 to 3 day halt essentially. This put around just over 2 million barrels a day of crude oil on hold. So that's around 2% of the world's global crude supply, essentially. So as I said, it's come back online. So reports said it's come back online as of Sunday. So things appear to have, so despite that initial rally we saw in flat price because of it, things are looking like they're normalizing finally. There is still a lag. So the figure that I mentioned, just over 2 million barrels a day, that is including Kazakhstan's CPC terminal loadings as well. So these are fairly important crude loadings. And now we're seeing a bit like a 1 to 2 day lag in future loadings just for the time being. That said, just in terms of flat price and who's pricing this in, how the market is reacting, considering that we're back to 63, I don't see a lot of disruption being priced in, and just volatility has been fairly muted. If you look at my chart over here, volatility. So this shows volatility in Brent open in Brent options. So the white line over there is out of the money volatility and out of the money call options. The orange line is volatility and out of the money put options. So the first two circles that we see are spikes that we saw. The first one on around the Israel-Iran war in June. The second when the sanctions on Rosneft and Lukoil were announced. Compared to that yellow circle that we see at the end, we did see a small increase in volatility, but it seems like the market sort of...
That, though, one huge, great big dollop of volatility.
Exactly. So I feel like it's just the market's fairly range-bound right now. It'll be interesting to see how the market is essentially looking at this whole Russian sanctions thing, considering Deputy Prime Minister Alexander Novak also mentioned that crude oil production in Russia, although it did slow down in October, it was below OPEC's quota. It is reportedly increasing in November, and it could match up the quotas by the end of this year. But I think, Harinder, you had more to say about Russia, the sanctions, and what developments are following.
Absolutely, Mita. So as Mita mentioned, the sanctions on Rosneft and Lukoil, the two big Russian majors from Russia, those two companies, there's a number of sanctions that have been placed on them in terms of restricting the activity, but the extent to which those sanctions are actually taking effect remains to be seen. And as Mita pointed out with the volatility, you didn't get nearly as much of an increase as we saw earlier in the year with the huge spike in both call and put volatility. So I think it's interesting to note that in spite of the sanctions being put in, there are a number of exemptions that have been put in place as well. So the most notable one, I think, is the CPC pipeline that Mita rightly mentioned, the Caspian Pipeline Consortium. That's effectively a pipeline between Kazakhstan and Russia, and Rosneft and Lukoil have a pretty integral share in that pipeline, and they're being permitted to continue with their investment in, I guess, their equity share into it and the extraction process for their downstream processing. They're being permitted to continue with that until the 21st of November. So that's coming up pretty soon, that restriction, that timeline. But there are also longer extensions that have been put in place, more country in terms of countries. So Hungary, for example, has been given a 1-year exemption for Rosneft and Lukoil to divest their assets to be able to fully withdraw. On top of that, Bulgaria, Lukoil owns the biggest refinery in the Balkans in Bulgaria, responsible for between 40 and 60% of the wholesale fuel market in Bulgaria, so really pretty massive. And they've been given until April 2026 to be able to withdraw from that. So perhaps this market reaction is in full view of the fact that although these sanctions appear to be rather substantial, there are a lot of these caveats in place to allow the two majors to withdraw their assets, withdraw themselves fully, so the effect won't be so immediate.
Just a word on that Hungarian extension, though. For you guys on the desk, did that particularly take you by surprise, or do you think there's lots of background underlying factors to an extension like that?
Yeah, I think it comes as a means of, as a show of power politically, to say we're going to sanction these Russian companies heavily. But of course, they don't want to be so disruptive that the oil is off the grid immediately, so to speak. So to allow them to have the time to withdraw, to allow those assets to find a new home, potentially to find new investment, will keep the oil flowing. If they were to implement them so quickly and not give this cool down period, if you will, then it could have been a lot more dramatic.
For sure. I think with Hungary specifically, there's obviously a lot of political allyship there as well with Trump and Viktor Orban. It'll be interesting to see. I think we're also hearing reports of a potential delay in sanctions now, just generally as well. So I think this is a bit where like the whole Trump taco play comes into quite focus as well. So it'll be interesting to see how these sanctions are, how the timeline looks on them. I think with these sanctions, it'll just over time, we currently hear reports of, I read a report that said something about Russia offering discounted LNG to China. So there is a lot of question about how much of supply is going to be disrupted, because considering that flat price is currently at $63, not at 70-something dollars. You know, I don't exactly know how much of the supply disruption is the market really pricing in.
Exactly. We'll see how that plays out. All right, Mita, let's move on now, if we may, to refined products. What's the latest in particular with the refinery margins?
So refinery margins, as we discussed in last week's show as well, are still very high. They've seen a small correction today, but they remain fairly elevated. However, last week we mentioned that the major drivers behind this strength were gasoline and gas oil. So gas oil remains relentlessly supported, and we'll talk a bit more about that in the section. But I also want to talk about gasoline because that market is starting to look slightly shakier. So the EBOB crack, which again has been so strong, is now starting to see some weakness. It softened from a high of $17 to around $15, $70. Distillates, though, as you can see on my chart over here, distillates remain very high. So I think margins right now to me appear very middle distillates versus everything else. Like everything is starting to, like you can start seeing some cracks forming, but middle distillates remains high. We saw around a $4 increase in cracks day on day yesterday. So they reached above $39, which to me is fairly indicative of stop outs as well. We'll see. We'll have our position data come out over the next few days, and we'll see how to corroborate that. But just a day-on-day spike like that does hint at stop outs. We have since seen a correction. I think these levels are a bit too much for the market as well. We are starting to see resistance here. The crack is now at 36.30. And in terms of spreads, so the front month versus second month gas oil future spread was briefly at $45, which again, very indicative of supply tightness, but also demand increases. Assuming as we inch closer to winter, stocks start trickling down as well. And I think we mentioned in last week's show as well, we are beginning to see cold weather. It is so cold in London this week. And that'll be really interesting. Just on the distillate side, because I did say this feels very distillates versus everything else. Jet fuel, which is also a middle distillate product, has also been really strong, especially in Asia. So in Asia, we have this contract called a regrade. So regrade is jet fuel essentially versus Singapore gas oil. And that is currently positive despite how strong gas oil and diesel have been. So the fact that being so strong also is fairly reflective of how strong the jet fuel market is, especially in Asia. A lot of that has to do with seasonalities. Japan tends to use kerosene for wintertime heating. It's fairly seasonal for that, but also from the US West Coast. So we have seen refineries in California shutting down, and recently we saw Chevron's El Segundo refinery catch fire. So there has been a pull of supply from South Korea, and recently India exported its first ever jet cargo to the US West Coast in its history. So we have seen that Asia to US West Coast move in jet fuel. That will be interesting to monitor as well because Thanksgiving is coming up, and that's when aviation travel, motor demand travel should increase as well. So
and lots of car travel too.
Yeah, exactly.
Using a lot of fuel.
Exactly. So we'll talk about US gasoline later in the show, but for now, aviation demand in the US West Coast. So do keep an eye on that. On a final note, stronger ICE gas oil has also weighed on the gas oil East-West. So the gas oil East-West looks at Singapore gas oil versus European ICE gas oil. The M1 East-West was briefly at around negative $50 per metric ton, which is among an all-time low for this time of the year. It has since come up. It's around negative 41, but a lot of this could also be due to freight being really expensive, making it expensive to send these cargoes across. Other East-West have also been affected by this, but I think Harinder is going to talk a bit more about that.
Absolutely. As Mita rightly mentioned, the gas oil East-West, we're looking at levels that were previously unseen, around negative $50 per metric ton. As she mentioned, freight as well, being particularly high, being particularly strong during these periods has influenced that. With the naphtha East-West, which is the one I want to focus on a little bit, with our positioning data is really coming in powerful. So a little bit of context again into the market. So naphtha in the East, the Eastern naphtha benchmark, has seen a lot of strength due to these cracking units coming online, which will take naphtha as a feedstock, as an input, and crack it to produce petrochemicals, which are later used for manufacturing plastics. So the introduction of these new cracking units, particularly in Indonesia, has meant that demand for naphtha in the East has been pulled up. Coupled with, of course, the Russian sanctions, less Russian naphtha coming in, and the wider sort of geopolitical landscape around there, it's meant that the Eastern naphtha benchmark has strengthened quite significantly relative to the Western one. And what that's meant is the East to West naphtha contract has widened significantly. So if we take a look at the chart on the screen here, which showcases the price evolution of the East-West, along with our positioning data, we see this continual uptrend in the East-West price. And we actually see that our positioning data is showing that the counterparties have been selling the contract as it's been climbing.
Gosh, that's quite steep, isn't it?
It is, absolutely. So it accumulated in a net position close to negative 3 million barrels as the prices continue climbing. And since then, these people that have entered short have been unable to defend their short positions. They've gone and liquidated. And if we take a look at the open interest as well, it would show a relatively flat open interest, which basically means that the players are exiting and entering positions simultaneously. So these short positions coming off is an indication of real removal of those shorts, which is happening if we take a look at the entry price at a loss, effectively. So they're buying back these contracts as the price is creeping higher and higher at a loss. So it just really goes to show that in spite of the positioning, being so deeply short, it turns out that they've been unable to defend those shorts, and now prices have climbed and they're out of the money. So I think that's...
So is it their own fault, perhaps, that they literally misread the drivers or the market?
Indeed it is. Perhaps they thought that these levels are so high for the East-West. Of course, there'll be some hedging component.
For sure. I think it's really interesting that refiners specifically have flipped from net short to net long, but that just means that they've unbound their hedge positions. That's not really something that we see every day, so that's fairly interesting. And also on the point of defending their positions, I think it's really interesting that prices have essentially bounced off of the long entry prices. The 90-day longs did not allow themselves to be out of the money at all through this period. Really interesting.
Really interesting, yeah. So,
right, well, while we are discussing oil products, Mita, I think there's been some news, especially coming out of Nigeria's Dangote Refinery. Has there been an update on their maintenance schedule?
Yes. So there's reported updates that Dangote is a 650 kilobarrels a day refinery in Nigeria, and they have reportedly postponed their reportedly postponed maintenance on their crude distillation unit till the end of Jan. So it was initially planned for early to mid-December, and they've postponed this for the end of January. The maintenance on their RCC unit, which is used to make gasoline, has been brought forward to 15th December instead. So just in terms of how this could impact oil products, for pushing back, like bringing back their RCC maintenance would be supportive for EBOB, for European gasoline, although levels are really high right now, so we could still see a short-term correction, but there is some support here on lower. For example, if we do see a correction lower, we could see a floor just from this RCC news. Interestingly, also, a delay in the CDU maintenance while the RCC is brought forward may lead to more LSSR, that is low sulfur straight run fuel oil, being sent from Nigeria to Singapore in the short term, which could potentially dampen Sing 0.5, Sing VLSFO as a whole, so in the prompt especially. That should be something interesting to look out for, especially because our positioning data shows trade houses buying the DEX Sing 0.5 crack against Onyx recently. So this could leave these players, these long trade houses, vulnerable to a bearish catalyst, especially with open interest in the crack currently very close to the 5-year maximum. So there isn't a lot of room for them to keep defending their positions in terms of how saturated the market is. So if we do see a bearish catalyst in the market from this RFCC news, from this CDU postponement news, that'd be really bad news for them.
Just on the maintenance issue, though, I mean, most refiners have to do maintenance at some point, don't they? I mean, we hear so often about fires, outages. I mean, that suggests that maintenance is needed.
Yes, for sure. But I think in this case, there has been so much question about the exact maintenance schedule there are so many moving parts here. First, there is the CDU, there is the RCC unit, both of which impact, in this case, fuel oil very differently. Initially, what we heard rumors of were that the CDU would be shut more than a week before the RCC unit, in which case we'd first see support in VLSFO due to a curb in exports from Nigeria to Singapore, and then we'd start seeing more VLSFO supply as the RCC unit goes offline. But now with the CDU maintenance still well in the future, but the RCC maintenance approaching, that's a bit of a surprise news. That's a bit of a shock for the VLSFO markets, essentially, is what we're seeing. So I completely agree. And a lot of times we do see seasonal plays in the market. For example, we start seeing support in Q2 gas value East-West because of refinery maintenance. We expect Asian markets to be tighter at that time. So we do see the market does price in refinery maintenance. It does also want to look out for unplanned maintenance or random shock news like this, where you see changes that nobody saw coming, essentially.
All right, brilliantly explained. Let's move on now then, if we may, and talk a little bit more about the futures market. Have there been any interesting changes in positioning in particular recently?
Yeah, so there's been a few contracts that have been especially interesting. Of course, to start, Brent, there's been a small increase in the open interest. So in previous weeks, we've seen drops in the open interest, indicating that players in the market have taken off risk. But the real standout contract, as Mita mentioned as well, is the gas oil complex. So if we take a look at the positioning in the producer merchant category for gas oil, this is not too eventful in week on week. We can see that they're maintaining their short positions. But what was especially interesting in the gas oil category was the money managers. So now if we move to the money manager positioning, which is far more indicative of the speculative players in the market, we can see a week-on-week addition of net length. So we saw longs, so this is the net position week-on-week, increase overall by 7.74%. And this is the third consecutive week of increases. What this is telling us is that these speculative players continue to add length to gas oil, and they're doing so at higher prices. So there appears to be perhaps some conviction as prices are moving up, that they continue to do so. These are speculative players, so they're not doing it. It's not for hedging purposes. It's because they do believe with some conviction that prices could potentially continue to move up. So this is the less timely data, the CFTC. But again, it does go to underscore the point that gas oil is the contract where there's a lot of conviction, especially at this time towards the end of the year when players tend to be a little bit more risk off going into Christmas. Locking in their bags, as Mita said, exactly.
Yeah.
So,
Right, brilliant, Harinder. Well, we know that official COT data is lagged, of course, by a week. So what does Flux's timelier positioning data then tell us?
Yes, exactly as you mentioned, the data we just looked at was lagged. We have a CTA model which is capable of giving us positioning day to day, which is far more granular and can give us a lot more insight. So if we take a look at the chart here, which shows the futures contract CTA positioning over time, it's in some sense it's more of the same in that we remain overextended in gas oil and heating oil, as mentioned in previous weeks. In fact, we've seen even more of an increase tick up, which could potentially indicate we're overextended. But it could also suggest a new normal. If this continues to be the case and we continue to see positioning at these high levels, the underlying model that looks at the position will start to acclimatize to this level, and this will become the new normal for positioning. So if money managers do continue to keep buying, do continue to keep adding positions, the CTAs will similarly reflect that state of normality. So it could be the case that these high levels for gas oil will persist a little bit longer as positions remain here. I think one thing to point out that's especially interesting as well with CTAs is RBOB, which is the US gasoline contract, has started to move up to neutrality, so in terms of like zero level of positioning, and there remains a little bit of room to the upside in terms of adding positions and potentially supporting prices of US gasoline. This comes in especially interesting for our trade idea later. RBOB is a really important component of the arb between US and Europe, and we'll start to see how this could potentially play into that at the end of the trade idea. So that's one to watch out for.
Mita, go along with that?
Yep, I do agree with that.
Right, let's shift focus now then to the oil swaps market and Flux's very own commitment of traders data. Has there been a recent contract perhaps that's particularly stood out this week?
Yeah, so we did speak about this earlier as well in last week's show. That was our main trade idea then. We're going to talk about the prompt DFL, that is the dated Brent versus Brent swap spread. So this particular contract fell to a low of, as you can see on my chart here, it fell to a low of around 15 cents per barrel just at the start of November, around mid-November. But over there, it saw better buying. And if you see my chart, if you see the next chart after this, you can see that refiners have been primary drivers of this buying. So we initially saw them de-risking, but then we saw them buying at lower levels, buying on the way up. They are now 6.5 million barrels long this contract against Onyx, and they've added 3 million barrels of this just over the past fortnight. So they've not added too much just over the past week. They have still added a muted version, comparatively muted volumes, but they are holding on to these longs, which is important to see. Longs are now in the money, but its current prices are around 63 cents, and the 90-day average long entry level was just under 40 cents. So they're comfortably in the money. And we hold a fairly bullish view of dated Brent over here.
Well, just let's explore that a little further. I mean, what's your view on this contract based on that?
Yes. So On the paper side, as you can see, refiners returning to adding length, buying a lot over this past fortnight, buying at lows. We have seen that floor in the contract. But just on the physical side as well, we see support in the North Sea physical. The physical differential in the North Sea moved up from a low of -$1, below -$1 at this over the past 2 weeks, to 73 cents just yesterday. This is -73 cents, sorry, just yesterday. This is based off the officials' assessments. So do check their show and their reports as well.
Absolutely.
But so based on that assessment, we have seen a day-on-day increase, a day-on-day recovery in the physical. And yesterday we saw a good bid in 40s cargo by Mercuria, up to 80 cents below dated. This is for early December cargo. And just if you look at the paper market as well, the paper market is also implying more support. We are seeing the 24-28 1-week roll, that's just for the week ahead, 1-week roll, move up from -30 cents per barrel on 12th November to around -5 cents per barrel just before recording the show. So we are seeing more support being projected, being anticipated in this contract. And should we see the support materialize, we should start seeing this towards the end of this week.
And we're recording the show, of course, on Wednesday, the 19th of November. All right, just taking a break then now from that positioning data. Shall we dive into another interesting way of analysing the market through the means of technical analysis, which uses statistical trends gathered from past data, of course, to derive insights from the market. Mita, could you just talk us through any interesting shifts in the market, technically speaking?
I would love to. So just starting with Brent, just it being the most liquid of our oil futures. So Brent has been, as I mentioned, we have been fairly range bound. 50-day moving average, that blue line on that first pane on that chart, has been a very significant resistance level for this contract, as you can see just from the past fortnight. Like looking into price action into November, it's been a very clear barrier for price action. They're not allowed to go above that blue line. Just from an algorithmic point of view, crossing that blue line by more than one standard deviation, or for 1 to 2 trading days as a close above this line, would encourage further buying, because a lot of systematic traders would look at this particular level, and that would encourage crossing above it would encourage more buying. Momentum, as reflected on the second panel over there, that is a stochastics indicator that shows how short-term moving averages have been interacting with longer-term moving averages. The fast stochastic line is now well above the slower one. That shows building positive momentum. But I do think that the 50-day moving average is still something that should be more of a focus over here, because that's been a very important barrier for this contract. And just the second contract I would like to talk about is European gasoline, just because of all the talk about how we are starting to see cracks form in the contract. So this is a really good demonstration of that. So we've seen good strength into Q4. So October onwards, we've seen the December EVA crack just on an uptrend. It's just been relentless, and it increased to a high of over $17 this week. But that's where we started seeing resistance, and now it is currently around just above $15. And just looking at the MACD line on the second panel over there, that shows, again, similar to stochastic, that's an indicator of momentum. And although we are still in the positive here, the MACD histogram is still above 0. It's very barely so. That chart over there reads 0.04, so it is fairly level with longer-term moving averages. So this currently looks at a difference of short-term versus long-term moving average, and then it further smooths that line. So a decline in the MACD histogram below 0 would also be a sell-side signal for a lot of traders. So keep an eye on that, considering that it's currently around 0.
Really close. Yeah.
Yes, very close to it. But on the support side, that orange line that's going up alongside prices is a very important support line to keep an eye on. That is the 10-day moving average. A break below that, which is very important because we are currently testing it, as you can see over there, would immediately open room for the yellow line over there, which is the second line of support. That is the 30-day moving average. And I really like the candlesticks on this chart. I'm going to focus a little bit on that. So just going on these particular charts over here. Can I circle them? No, but just around the 12th of November, we see really small real bodies on those candles and longer shadows that shows rising indecision in the market. And that is around the time we were at highs that we've seen this week. So that level started to build up indecision in the market, and then we started seeing bearish candles forming. So do keep an eye on how that goes. But on a technical level, on a technical basis, there are very clear warning signs in this contract.
Take us on to the trade idea.
Yes. So the trade idea is related to European gasoline. Harinder's going to take us through that.
Exactly. So exactly as Mita said, I think there's a lot to unpack with EBOB cracks, and rightly pointed out, cracks in the EBOB crack are really beginning to show with the stochastics, with the technicals. And the trade idea really builds off that idea. So we're looking at the ARB, as I mentioned. There's a difference between US gasoline, the ARB contract, and European gasoline, the EBOB contract. So our idea is that we should be going long the ARB, i.e. buying the ARB. So that would mean buying the EBOB contract, selling the EBOB contract. And given how EBOB cracks are looking right now, we're teetering on the edge. I think that there's a very strong technical argument that can be made there for selling that EBOB contract. Again, as Mita pointed out, that second line could be a good level of support to target as prices could fall through. But looking specifically at the ARB, so the difference ARB to EBOB, in terms of fundamental data, so we would look at the inventory data in the US, the EIA data, which tells us about the stocks in the US. Those have actually been surprisingly strong. And ARB hasn't really reflected that too much. So this could be a signal that there could be some reversion up in prices that could be captured. And then the other thing that was interesting as well is the actual chart itself. So if we take a look at the price action in the ARB, which has steadily slid down, we're now at levels around 35 cents, which is incredibly low for the ARB to EBOB ARB, and could represent a very strong buying opportunity. So, and then again, the technicals on this chart or on the EBOB crack can further bolster the argument that we're making. So yeah, the ARB I think is a pretty strong buy from our perspective. And in terms of positioning as well, that we've recorded as Onyx, a lot of players have been selling the ARB, and generally that's a hedging activity, but there could also be some speculative interest there. So to lock in that voyage from Europe to US, you'd sell the ARB contract, buy the EUR contract. So that hedge could potentially unwind if we start to see this pick up. And because there's been so much selling flow that we've recorded, Onyx has recorded, that could if that flow was to unwind, similar to how we saw it with the naphtha East-West, right? When we saw all that selling flow, if that were to unwind, that could really provide a sort of a tailwind to the prices moving upwards. So there's also an argument from positioning to be made there. So all these different factors coming together could really see this contract pick up and be profitable if someone were to go long.
I think especially because open interest in the ARB is currently really high. It's around the 5-year maximum. Same with EBOB. So there is a lot of oversaturation in these markets that leaves these players vulnerable to a reversal. And as you correctly pointed out earlier in the show, Lisa, Thanksgiving coming up, that is definitely a bullish indicator, a bullish driver, potentially bullish driver for US driving versus European driving. So.
Thanks so much to both of you. We've learned so much already, but we're not done yet. Because I'm going to put you on the spot, as we often do towards the end of the show, because it is our crystal ball prediction moment. Let me ask you then, where do you see Brent going in the coming week?
That's right.
I'll kick off. So I think with the sanctions, I think to start, of course, the narrative has now become quite deeply instilled into the market. It's clear to the market's well aware that these sanctions have been implemented. They're now aware of the various exemptions that are in place. So I don't think any more headlines on that front, which was really the big mover earlier on, will be particularly significant. From my position as I see it, given that we're heading into December, as Mita pointed out, traders want to lock in their bonuses. They're not too keen to take on extra risk. The market's a little bit more risk off. I don't expect that we see particularly big movements in any of the contracts. I think for Brent, we're going to be in a relatively tight range. Perhaps for gas oil, that's the one that could be the exception. We've seen it picking up. Although I think we've seen a little bit of a correction lower recently, which could be indicating that those traders are like, you know what, I've made some good money here. Perhaps I'm going to liquidate my positions and take it easy into Christmas.
Wow.
So I think for gas oil, there could potentially be a little bit of a retracement. But I think for those two contracts, that's my view.
I do agree with that, because I think I'm going to add a third layer to that. So Brent, I do agree. I think I am a firm believer in that blue line that I showed over there. I don't see us breaking significantly past it, maybe for a bit and then coming lower. I don't see any fundamental reason to believe that it should go above it. But I do think we're going to be fairly supported, and that's because of Brent spreads. So the front month versus second month Brent spread, I think, is currently at fairly low levels, considering it is almost an expiry spread. Expiry being the Brent futures expiry is coming up at the end of this month. And I think just based off that, I see some upside in that spread, which would then keep the futures fairly supported here. In terms of gas oil, I completely agree. I think it's hard to be too bullish over here, but I don't think we're going to fall off a cliff or anything. I think we're going to be fairly supported as the market's super cautious, I think. And yeah, but that said, if we do fall below critical support levels from here, I think gas oil is like the final straw that's essentially like the final thing keeping refinery margins up right now. So if that starts falling, that could be really bad news for refinery margins and then for crude demand. So I had to end this on a negative note. Right now, I am fairly cautiously bullish Brent spreads. Let's end it on that.
We're going to hold you to that. Thank you very much indeed, Mita Harinder. And that is it for this week's Flux Insight Show. Do hope you enjoyed it and learned a lot. I certainly have. Huge thanks, of course, to our fabulous research team, Mita and Harinder. See you next week. And remember, for a deeper dive into our research and data offerings, you can visit flux.live and feel free to, naturally, to reach out to us with any questions and comments. See you all next week.